In February 2006, Yahoo employed roughly 12,000 people and generated $6.4 billion in annual revenue. The company was still classified as a technology firm, still described by analysts as a platform, still governed by a board that met on a predictable quarterly cadence. Terry Semel held both the CEO and chair roles. Product leaders reported upward through centralized divisions. Acquisition proposals moved through corporate development, then finance, then the full board. The system functioned because it had always functioned. One procedural detail stood out even then. Acquisition authority rested with a small internal committee that required unanimous support before escalating anything transformational. At the time, that requirement seemed like discipline. Yahoo had grown through dozens of deals during the previous decade, most of them small, most of them quickly absorbed. The committee's role was to prevent sprawl. It filtered targets, calibrated valuation ranges, and shielded the board from noise. In practice, it also meant that dissent halted motion entirely. No tiebreaker existed. No escalation protocol bypassed it. Nothing moved forward without alignment. That design choice mattered later. In 2006, Yahoo's operating rhythm still reflected its portal origins. Homepage traffic remained massive. Advertising revenue grew steadily. Search monetization lagged Google's, but the gap was framed internally as temporary. The board's incentive structure reinforced that framing. Executive compensation was tied to revenue growth and margin stability, not user engagement or product velocity. Equity awards vested on multi-year schedules. Continuity was rewarded. Within that system, acquisitions were framed as supplements, not pivots. They were meant to add features, expand audiences, or accelerate timelines, not redefine strategy. That assumption went largely unchallenged in formal meetings. The first serious challenge arrived through a term sheet. July 2006, Yahoo evaluated an acquisition proposal for a fast-growing video-sharing platform valued at approximately $1.65 billion. The target's user growth exceeded Yahoo Videos by an order of magnitude. Its infrastructure costs were rising. Its revenue model was undefined. Corporate development supported the deal. Engineering leaders raised concerns about copyright exposure. Finance questioned scalability. The committee did not reach unanimity. The proposal stalled. What mattered was not the rejection but the process. No vote was taken. No memo summarized dissent. The item simply remained open. 2 weeks later, Google closed the same acquisition. The committee recorded the outcome as a valuation discipline success. Product teams recorded it as a missed inflection. Both interpretations coexisted without formal reconciliation. By the end of that quarter, Yahoo adjusted its internal video roadmap. The change was subtle. Budget allocations increased. Hiring requests expanded. No one referenced the acquisition again in full board sessions. The system absorbed the outcome without visible disruption. 6 months later, another proposal arrived. In early 2007, Yahoo entered discussions with a rapidly growing social networking company valued at roughly $1 billion. The platform's engagement metrics were unprecedented. Its revenue remained minimal. The founders insisted on operational independence post-acquisition. That condition triggered the same committee constraint. Independence conflicted with Yahoo's integration norms. The committee split. Again, no escalation occurred. This time, the delay had secondary effects. Legal teams began drafting alternative partnership agreements. Product teams were instructed to build overlapping features internally. Finance adjusted capital allocation assumption to account for higher internal development costs. None of these actions were presented as substitutes for acquisition. They were framed as prudent contingencies. Within 6 months, the target accepted an offer from another buyer. The board did not revisit the process. From the outside, Yahoo appeared active. It launched new products, refreshed its homepage, announced incremental deals. Internally, acquisition discussions continued, but the threshold for consensus rose. Each stalled proposal became precedent. Committee members referenced prior restraint as justification for future caution. The absence of failure became evidence of correctness. By mid-2007, external pressure began to shift. Google's market capitalization widened. Facebook's growth attracted sustained media attention. Analysts altered their language. Yahoo was increasingly described as a media company rather than a technology platform. That reframing mattered because it affected valuation assumptions. Media multiples compressed faster. Technology multiples expanded. Inside Yahoo, interpretations diverged. Finance viewed the reclassification as temporary market sentiment. Product leaders viewed it as structural risk. Both groups referenced the same quarterly numbers. Revenue was still growing. Margins remained intact. The disagreement was about trajectory, not performance. That disagreement never reached a vote. In August 2007, the board approved a governance adjustment. The acquisition committee's mandate was expanded to include strategic alignment review. On paper, this clarified priorities. In practice, it added another criterion to an already unanimous process. Alignment was not defined. No metric operationalized it. Each member interpreted it independently. Within 3 months, 2 additional acquisition discussions entered review. Both exceeded $500 million in proposed valuation. Both involved user-generated content platforms with unclear monetization. Both stalled at alignment. At the same time, meeting frequency increased. The board convened special sessions focused on competitive positioning. Advisors were invited to present market maps. The maps showed Yahoo occupying multiple overlapping categories with diminishing differentiation. No immediate action followed. The first external signal arrived through proxy commentary. In early 2008, shareholder communications began referencing strategic optionality. The phrase appeared in analyst notes, then in investor questions. It did not refer to any single decision. It described accumulated hesitation. Management responded by reiterating confidence in organic growth. That confidence was tested abruptly. In February 2008, Microsoft submitted an unsolicited acquisition offer valuing Yahoo at approximately $44.6 billion. The premium exceeded 60% over Yahoo's pre-offer share price. The board convened emergency meetings. Advisors were retained. The acquisition committee was bypassed entirely. For the first time, unanimity was not required. The board rejected the offer. The decision was framed publicly as undervaluation. Internally, the reasoning was procedural. Accepting would require admitting that prior acquisition discipline had constrained growth. It would also transfer control under conditions set externally. Directors debated alternatives: negotiate higher price, pursue partial asset sales, or reaffirm independence. Each option carried constraints created by earlier decisions. Negotiating higher required demonstrating standalone strategic clarity. Partial sales required identifying non-core assets, many of which had been retained precisely because acquisitions had stalled. Independence required renewed confidence in internal execution. The board chose independence. Within weeks, market conditions shifted. Yahoo's share price declined. Microsoft withdrew. The option space narrowed. What had appeared as parallel paths collapsed into sequential dependencies. Each alternative depended on credibility that was no longer available simultaneously. Leadership stability became the next variable. In June 2008, Terry Semel resigned. The roles of chair and CEO were separated. The board appointed an interim CEO while initiating a search. This governance change was presented as renewal. Procedurally, it redistributed agenda control. Directors now set priorities directly. Management discretion narrowed. During the transition, acquisition discussions resumed. This time, the constraint was time. Any deal would be evaluated by outgoing leadership, approved by an interim structure, and inherited by a permanent CEO. Advisors flagged integration risk. Targets demanded clarity on authority. The committee process returned, now layered beneath new oversight. No major acquisition closed. By 2009, Yahoo's market position had shifted decisively. Advertising growth slowed. User engagement plateaued. Competitors consolidated network effects that Yahoo had once evaluated as too early. Internal reviews documented the history of declined opportunities. Each memo emphasized rational justification at the time. None addressed the cumulative effect. The system had not failed abruptly. It had operated exactly as designed. The file shows 4 major acquisition discussions between 2006 and 2008 that advanced to final review and stalled without formal rejection. It does not answer whether those decisions reflected prudence or whether unanimity itself became the decisive actor.